Hello, everyone, and thank you for joining us today. My name is Tiffany McKenzie, and along with my colleagues from Wakely and HMA, we are glad you're here for a discussion on the key considerations of the 2027 Proposed Notice of Benefit and Payment Parameters. Now, before we get started, I just wanted to mention that today's webinar will be recorded, and along with the slides and the recording link, we will be sending them out to all registrants. And while our panelists are presenting today, I'd like to encourage you to submit your questions in the Q&A, and we will leave some time at the end to answer those. Now, let me introduce you to our panelists. Michelle Anderson is a director at Wakely who brings more than a decade of experience supporting ACA insurers through market strategy, plan design, pricing, policy analysis, risk adjustment, and financial modeling. Michael Cohen is a principal at Wakely with deep public sector and federal policy expertise, including nearly 8 years at CMS and the White House, advising clients on ACA markets, exchange policy, and healthcare econometric analysis. Lena Rashid is a principal at HMA and a nationally recognized healthcare policy leader with more than 15 years of federal experience, known for advancing ACA and marketplace initiatives, launching the Section 1332 waiver program, and helping states expand coverage, lower premiums, and improve access through strategic policy and outreach leadership. Corinne Rastaji is a healthcare actuary and risk adjustment specialist who advises health plans, technology companies, and policymakers on actuarial strategy, market dynamics, and the financial implications of healthcare reform. And last, Zach Sherman is the managing director at HMA and an ACA and health insurance marketplace leader, recognized for launching and transforming state-based marketplaces, driving enrollment growth, and delivering operational and policy results through collaborative leadership across government and industry stakeholders. Now, with that, Zach, I will ask you to go ahead and take it from here.
Thank you, Tiffany, and thanks everyone for tuning in today to explore this important topic with us. I'll say at the top, we have a great panel of experts who have dug very deep into this proposed rule and its potential impact on the ACA market, consumers, stakeholders. To the extent you would like to engage with us after today's session to dig into any of these issues deeper, please don't hesitate to reach out. We are here to help. So for today's webinar, we're going to start with a brief overview of the proposed rule. We're going to follow that with an explanation of how these proposed changes, will play out in the context of other federal changes impacting the ACA market, which are on the horizon for the next 2 years. Then we're going to get into the impact of these proposed policies, both at the state level, on marketplaces, regulators, importantly for consumers, and we're also going to get into the pricing impact of these potential policies. So with that, I'm going to start with a brief overview. So Tiffany, to the next slide, please. So as we've dug into the rule and thought about it, we've tried to organize the proposed policy into buckets, which we have articulated here on the slide. We have 4 major buckets of policy priorities that are coming through from this rule, starting with the goal of expanding availability of lower premium plans with higher out-of-pocket spending, higher out-of-pocket caps. We see this through expanded availability and duration of catastrophic plans, flexibility to increase the max out-of-pocket on catastrophic and bronze plans, and the introduction of availability of non-network plans that don't have to comply with network adequacy. Second bucket we see is enhanced accountability on regulators, marketplaces, and brokers. We see this through a new state marketplace oversight program focused on improper enrollment, the ability for a state to establish a state marketplace through the enhanced direct enrollment mechanism, the reversion to older policies around defrayal the cost of state mandates on essential health, on mandates that exceed the cost of essential health benefits, and new network oversight responsibilities and opportunities. Our third bucket is targeted program integrity initiatives that we've seen before from the administration, from the Trump administration. A number of verification and enrollment program integrity requirements that many of which are returned from last year's marketplace integrity and affordability rule, some of which are still challenged and held up in court. And then the last bucket is proposed regulations codifying eligibility and tax changes that were enacted in the One Beautiful Bill Act, one Big Beautiful Bill Act. So that includes immigrant eligibility changes, some of which went into effect in 2026, some of which will go into effect in 2027, as well as the provision around removing the cap on excess premium tax credit that consumers have to pay back when they file their taxes if they received more in advance throughout the year. So that's a very brief overview of the major provisions. This is not everything that's in the rule. The rule is a 550-page document with a lot of technical detail, but we wanted to share the highlights and how we've been thinking about them from an organizational perspective. And with that, the last thing I'll say before I hand it over to my colleague Michael is that today's presentation is very focused on impact, on how these potential rule provisions will impact consumers, enrollment, pricing, and affordability. So with that, I'm going to hand it over to Michael, who's going to talk a little bit about how this proposed rule will play out in the context of other federal changes. Michael?
Thanks, Zach. Yeah, to your point, and I'm sure everyone on this call realizes there's a lot going on currently, as well as for 2027. And so, before stepping into what the proposed rule could do, it's probably important to remind everyone what is scheduled to happen. The first is the expiration of the enhanced premium tax credits. While that happened at the end of 25, the beginning of 26. The expectation from a lot of people is that there would be kind of continued effects into 2027. It took multiple years for the full effects of EPTC to be felt on enrollment, and the expectation is that it will probably take several years for unwinding to occur for the full effects of EPTC to be felt into enrollment. CBO, as part of their projections, believe or estimate that it'll take about 3 years before enrollment kind of hits a steady state vis-a-vis the expiration of EPTCs. And therefore, you would expect some sort of downward pressure on enrollment in 2027 relative to 2026. The second thing going on is the reconciliation bill, OBA, which starting in 2027 will have new provisions go into place. In particular, certain legal immigrants will lose access to APTCs, right? This includes people with pending asylum applications, those that have been granted asylum, temporary protected statuses, temporary workers, and a few other categories. And all told, this is expected to have a non-insignificant number of people losing their APTC eligibility. Last is as part of the program integrity rule, starting in for 2027 is that there's a shorter open enrollment periods. There's limits on when open enrollment can start and stop and how long it can be. And especially for marketplaces that had enrollment periods that went into mid-January till the end of January, the expectation is that there could be effects on enrollment, as enrollment is generally probably going to be for this upcoming year between November 1st and the end of December. And so especially in year one, there could be confusion and or missed enrollment generally that could happen. All of these kind of combined are expected to put pressure on enrollment and kind of axiomatically upward pressure on morbidity. CBO overall estimates that between 25 and 2027 that the non-group market on average could shrink by about a third. And so this is kind of the context that that the proposed MBVP is entering in. And that's obviously before all the other uncertainties that are kind of swirling in the background. So given that context, maybe we can move on to the next slide. So as Zach said, just to focus on the major kind of what could the rule do in terms of enrollment effects, we'll handle pricing and kind of other kind of operational complexities momentarily. But what could it do in terms of enrollment? And the CMS itself estimates in its regulatory impact analysis about 1.2 to 2 million enrollees would lose coverage as a result of the rule in 2027. It's a little hard to parse this out though, and that's because we think within these estimates are included some of the OBA provisions. As Zach mentioned, as part of the rule, they're kind of codifying some of these the reconciliation bill requirements. And so kind of current OMB guidance on this is for agencies to include the effects of implementing statute language in its estimates of the effect of the rule. So in that case, right, the reversal of APTC eligibility for temporary for certain immigration populations would be included in that 2 million. And so if you were modeling or thinking about the effects of what would 2027 look like, if you were to take the full 2 million, you may be double counting if you're also estimating what the effects of the reconciliation bill were. And so it's a little hard as I said, to kind of tease out exactly what the impact of the rule directly has on enrollment, given the other moving components. Probably the single biggest proposed provision that could impact enrollment is the increased data matching issue verification standards. In particular, they propose kind of two changes that would be required on all marketplaces, regardless if they're a state-based marketplaces or a federal marketplace, which would be to have automatic triggers for DMIs if if an applicant's kind of known income is either below 100% or if that data is unavailable. CMS estimates that this could potentially result in about a 500,000 disenrollments. We think that the potential for this provision in 2027 could be higher. There's a lot of variation kind of state to state as to what successful DMIs look like. And in some states, some instances, kind of the disenrollment rate for those with DMIs is far higher than what we think CMS is projecting. And that's excluding potential some operational issues that the IRS may be having these days in terms of getting tax data available or combined with the kind of economic uncertainty kind of changes in income that the current environment is having. And so a combination of all of those is that there is potential for greater enrollment losses than what CMS estimates. And so that's all kind of being, as I mentioned, in terms of the context for what potential enrollment impacts the rule has, and kind of keeping in mind that there's still a lot of other factors, whether regulatory, statutory, or even kind of economic that are kind of occurring in the background that could change some of the enrollment estimates that I've mentioned. So there's bluntly a lot of uncertainty as to what the 2027 market will look like. With that in mind, I'm going to hand it over to Lena to talk through some of these things through a state lens.
Hello, everybody. And so I think what we wanted to start with are kind of how we see these different buckets of opportunities or changes within our state-based marketplaces across states and across the federally facilitated marketplace. And you're going to hear a lot more about some of these changes as we talk about pricing kind of later in this discussion as well. But in all states are subject to the defrayal policies for essential health benefits, which certainly have impacts for issuers and for states in terms of costs. You'll hear more about silver loading justification, which will be across the board. And for state-based marketplaces, which generally have more flexibility in their marketplace by design, there's opportunities here, but also trade-offs. And so state exchanges have the opportunity to do network adequacy already. The elimination of kind of the exemptions process for time and distance standards presents some decrease in burden. There's an opportunity for a state-led ECP threshold, even though the proposed rule lowers the threshold from 35 to 20%. And certainly for exchanges that are certifying their qualified health plans, they have authority under the regulations for certifying the QHPs that meet their standards and that are in the best interest of the consumers, which are mentioned in the rule itself as an authority that states can use. In terms of trade-offs, there's state exchange and proper payment measurement is a new responsibility for states that will take operational capacity and staffing capacity as well as costs. There's a number of things in the rule that talk about operational costs for new eligibility and enrollment functions across the board. And Michael kind of talked about these other two provisions as well and kind of timing for those requirements. For healthcare.gov states, there are opportunities for states to play more of a regulatory role. One is through the effective provider access review program for states that do want to take on network adequacy. States that do want to take this on would be responsible for doing that for network and non-network plans. The effective ECP review specific to the essential community providers. And there's also opportunity to tailor these to state-specific circumstances, meaning if you want to focus on behavioral health or mental health providers, which was noted in the authorities as well, you could tailor that to your specific state needs. There's an allowance, we'll call it, for states to do standardized plans in the absence of the federal government requiring it. If you're on the FFE, it's not as helpful because you can't preferentially display the plans the way you might want to. But there are, with regards to those limits that the feds did put away for the standardized plans, states could think about how they want to implement that. Likewise, for state-based marketplaces that are implementing their own standardized plans, they can continue to do that. And state-based marketplaces that don't have standardized plans could also think about opportunities there. On the next slide, wanted to think a little bit about how you deal with all the uncertainty and unknowns that Michael talked about, and how do you kind of plan ahead. And so we've kind of bucketed this into ways you can do more monitoring, collect more data to help inform your efforts this year as well as next year. So rate review remains a really useful tool. There's, I think, I know our states and our issuers have some fatigue from the multiple sets of rates from last year. And so I don't think we want to go that far, but you could think creatively about your actuarial memorandums or policy exhibits or the like to kind of take out some of these different changes that are happening and parse out what that impact really is to morbidity and what it is to enrollment. So as Michael talked about, the rule combines these things all together. It's a little jumbled with changes in law. And so those are some opportunities for states to think about, targeted opportunities to really understand what the impact of those changes are. And this is also in the absence of a lot of federal data, which is not necessarily available on FTR or DMIs or even SEPs in a lot more detail. That next one goes to for state exchanges and states broadly, thinking about your reporting tools for monitoring behavior for consumers that went through the things we just talked about when they're losing APTC, when they're losing DMIs. And lastly, we think information collected now can be helpful. One, parsing out those impacts is helpful because there is a lot of unknowns. There was litigation on some of these provisions in the past and uncertainty about what will happen in the future, and also just the tight timeline that you're all working towards for final rates. And also, as you think about the pre-enrollment verification requirements, there's certainly things and data that could be collected in the DMI space that may inform what that verification looks like in the future. And so next, there's some provisions in the rule that are a little open-ended and are requesting comment. And so we wanted to highlight those for you and things to watch out for in the public in the future that could be in regulation or guidance or something else. And so for medical loss ratio, there's a 3-year standard, and they're seeking comment on whether to extend that from 3 to 5. There's talk of reducing data submission requirements to alleviate administrative burden. And there's also this proposed change to potentially think about federal adjustments of state MLR standards without state requests, all with the backdrop of the fact that no state has requested that sort of adjustment thus far. On the next one, there was a lot done in this rule regarding EHB, but we don't necessarily think that's done. And as you know, there are changes to the pediatric dental and defrayal, which we talked about. So moving to the next slide, we can talk about the EHB reforms. And so they have suspended review of EHB benchmarks currently, and that's noted in the rule. This certainly presents challenges for states in terms of the benefits they can really offer their consumers. And we think this could signal revisiting benchmarks and processes across the board. And so that was noted as comment. Another notable comment moving forward is related to collection of premiums. And so there is currently some flexibility in how issuers can accept slightly less than full premium due. And so there's an option right now for 26. There's a couple of options that could be considered for 27, which were noted. One is 95% of net premium, which you'll see on the next slide, a fixed dollar amount that is up to 10, and also 98% of gross premium. And so in this world of uncertainty where premiums are going up with the expiration of subsidies, we know this is an important tool to help consumers that are to not fall into their grace period and not ultimately lose their coverage. And this is something that the Fed solicited comment on. They also noted comment on what flexibility SBEs may have, even if they don't do it in the FFE space. So something close to watch, and another lever that I think SBEs have used in the past. And lastly, I think there's also a lot of uncertainty related to silver loading, and I'm going to pass it over to Karen, who's going to talk more about pricing considerations and some of that as well. Oh, sorry, I went too far. I have another slide. Well, what we didn't include in the notice of benefit parameters were Section 1332 waivers, which over 20 states have, and states receive pass-through funding if they lower premiums in any way. This has been a priority of the previous Trump administration. It has been talked about publicly as a flexibility tool, but we did not see any changes to the guidance thus far. And the feds have also been engaging with the National Association of Insurance Commissioners on Section 1332 health insurance compacts, which are another opportunity for potential flexibility. The consultation from states did provide feedback that they wanted more flexibility in the design, and the guardrails for Section 1332 are kind of like requirements are similar to those in 1333 in some respects. And so this is something we thought we may see because it was a priority, but have not seen yet, and something to look out in the future in terms of tools in the toolbox for states to use. And now I'm really passing it over to Karan for pricing considerations.
Thanks, Lena. So I'm going to talk about the key pricing considerations. Sorry, my voice is not very good right now. I've got a pretty bad sore throat. So we pulled out specific changes, proposed changes that could materially impact pricing or produce uncertainty in the marketplace. So we're going to hit on each of those. Those are the bronze plan flexibility, CSR reconciliation and silver loading policies, non-network plan options, catastrophic coverage, EHB requirements, and then other potential changes to metal mix and risk adjustment as a result of some of the above changes. Next slide, please. So first one is the new bronze plan flexibility. Just to remind everyone, the regulation says that if you offer a bronze plan that meets the requirement of the actuarial value calculator, you can offer an additional bronze plan that ignores one specific element of the actuarial value calculator, which is the MOOP, the maximum out of pocket. Presumably, the goal is to reduce premiums by not paying, just not having MOOP in there. So we looked at approximately how much this would impact. So a plan with MOOP and deductible set at 12,000 could be increased all the way to 15,600 and could reduce AV by 6%. Now, who is this change likely to benefit? It basically benefits people who do not hit their MOOPs. So you would expect basically anybody who's not hitting MOOPs can go down to the lower cost bronze plan and save on the premiums. But what does it do to the claims and risk adjustment? Can you assume that your premiums would go down by 5 to 6%? And so if you look at people who are not hitting their MOOPs, their claim cost is not going to go down. And risk adjustment, if there is a significant uptake on these lower cost plans, the market average premium comes down and it reduces the amount of dollars that are flowing in the risk adjustment program. So payers pay less, receivers receive less. So it's very likely that ignoring the MOOP on the type of plan where that's typically purchased by low utilizers is not really going to materially impact premiums. Next slide, please. Actually, can we go back to the previous slide? I wanted to make one more point there. So the reason why this happens is the actuarial values, like how can you have premiums not going down by 6% when the AV is going down by 6%? Well, you have a situation where by law we're required to price the bronze AV based on market average morbidity. So the kind of data that's included in ABC may not reflect the types of people buying this plan. And that's really what we're getting at. Next slide, please. So some strategic and operational considerations for carriers that need to be factored in. Some participation strategies may evolve. Some carriers may exit bronze. There are carriers who do not currently offer a bronze plan. I have heard from a number of carriers that it's very difficult because of risk adjustment leveraging to make money on bronze. However, Wakely benchmark data obtained through Wakely Risk Insights shows that you can be successful in bronze. So you might hear two different things and both can be true at the same time. You might have, to the extent that plans pull out of bronze, if you're staying in and you're leveraging the strategy, you might have people jump into the plan from the previous carrier who decided to not offer bronze. And then on the operational side, there are a lot of smaller health plans who are struggling with the increasing amount of complexity, and they may find it hard to justify administrative complexity that comes with developing these alternative bronze plans and taking on the risk of being mispriced. Some carriers are very protective of their bronze pricing position, primarily because, I mentioned some carriers are profitable on bronze, some carriers are not. The ones that are, rightfully so, will be more protective of their bronze pricing position, specifically to offer a free bronze plan to a member. So to the extent that that carrier exists in your market and you introduce a lower premium, if a competitor introduces a lower premium bronze plan, then you may be forced to react competitively. And finally, if you do go down this path, some bronze plans have 3 PCP visits before deductible kicks in. Leverage that benefit to support your risk adjustment performance. And I'll pass it on to Michelle to talk about CSR reconciliation.
Great. So one of the items in the proposed MBPP were added regulations and requirements around reporting both of the actual 2025 data as well how that is developed into a 2027 assumption in the rate filing. So what does that mean? 2025 data, you will be required to report what was actually paid in CSRs as well as reported revenue. CMS has recommended the standard methodology. So for those of you who were around back in the pre-October 17 days when CSRs were funded by CMS, this was a standard process and is in that guidance. The standard methodology is the most complicated of all the methodologies that are in that guidance. So we'll get into what that means here in a second. For 2027, again, there's more requirements around development of that CSR loading factor onto silver, as well as how that is actuarially justified. And I think those words are really important as we think about, what does that mean? So there might be some misalignments between how the 2027 assumption is built up and what actually goes into the rate filing. This is particularly important in states that have mandated CSR loading methodologies or a mandated load for in itself. CSR loads are very contingent as well on the mix of membership that is enrolled. So as carriers think about bridging 2025 to 2027, there are a number of reasons why those would not be aligned. But there's also assumptions that go into what the 2027 CSR mix may look like. That is very circular. We have seen with competitive positioning, usually lower cost plans have a much higher proportion of CSR members and therefore a higher CSR load. From a 2025 reporting standpoint, some of the other methodologies and the guidance are a little bit simpler. Back in the previous CMS days, the simplified methodology, there's a couple options there, and other ways that carriers could build up estimated 2025 CSR costs. So given that was only recommended, there is some lenience there. It's a pretty high administrative burden to put the standard methodology in place if that is not already there, as it requires a full re-adjudication of claims. And that administrative burden may also make its way into the rate filing if that's going to incur costs for carriers. We encourage carriers to talk to their states to align regarding what will be acceptable from a 2025 reporting standpoint, as well as if they anticipate a misalignment between the actuarially justified load that they're calculating and what might be in a state to align on what will be acceptable. The URT is forthcoming, and that should include both inputs in that template as well as a little bit more guidance on what that means. So on the next slide, what does this mean for the long term? So HHS, they notably chose not to prohibit silver loading. So we're really in a status quo state currently for 2027. However, all of these new reporting requirements related to CSR adjustments are really signaling some potential changes in the future. These new reporting requirements will result in a lot more data for federal review. HHS has indicated that, particularly in those states with mandated CSR or silver loading practices, that it may analyze the data to better understand how they affect premiums, subsidies, and market dynamics. As a reminder, the higher CSR load results in a higher benchmark, meaning more APTC dollars being paid out. So HHS is explicit that the data collected could inform future rulemaking. This could mean placing limits on silver loading requirements or even potentially eliminating silver loading altogether. In order for CSR funding to come back, that would have to come through congressional action. CMS may instead alter or limit the silver loading practices through regulation. So that would be, for example, like the MBPP. So for issuers and states, there's some longer term uncertainty here as many pricing strategies rely on these CSR loading practices. This would also impact consumers, particularly in markets where gold is currently cheaper than silver. So there's more availability of low cost or $0 plans still in the market with lower silver loading or no silver loading. That would dramatically impact costs to members, increasing that and then the market composition. So on to the next slide. Non-network plans were also included in the proposed MBPP. So, what are these? These are essentially plans that do not operate with traditional provider networks. Functionally, these plans would set a fixed payment amount for each covered service, maybe as a percent of Medicare or an average cash price. And enrollees can then seek care from any provider willing to accept the plan's payment in full. But if the provider charges more, then the member would then be responsible to pay the difference, which is a very important concept as we think about these plans. The overall goal of introducing these plans was to reduce overall costs and result in lower premiums in the market. But right now, there are a lot of questions. There's a huge state of uncertainty as regulation really isn't clear on a lot of the items and how this would functionally work. So to point out some notable ones, first, to qualify as a qualified health plan, non-network plans must demonstrate sufficient choice of providers through reasonable access to providers willing to accept payment. So there's really unclear definitions of what does it mean around sufficient choice and reasonable access. States are given oversight, and so there may be variance regarding, how this is interpreted, how this is defined, and ultimately what will be reviewed in order to determine which plans are a QHP. There's also key questions on how this would interact with cost sharing provisions, tracking to the maximum out of pocket, inputs into the federal AVC for plan compliance. Those are all only for in-network providers. And so trying to understand what these non-network plans mean in this context are a lot of important key questions. Also thinking through how this would interact with the No Surprises Act and as well as preventative service requirements. So as we think about market impacts and feasibility of these plans, there's some few key constraints that come to mind. So first is risk adjustment. Is this workable? Risk adjustment heavily relies on full and complete data capture. So any claims that are not able to be received would highly impact diagnosis and data integrity, therefore increasing risk adjustment payments. Also, the absence of provider contracts may make it difficult for these non-network plans to engage providers in coding or medical record retrieval. That is particularly important as we think about RADV as well. That might make it harder to retrieve charts or just generally, being an outlier in the RADV audit. Regarding the risk adjustment accrual estimation, if there are regions where there are notable take-ups of these plans, estimating risk adjustment accurately will be increasingly difficult. There will be shifts in market membership, buy down to lower, cheaper plans, shifts in the morbidity. There's also potential for backlash from consumers. So because providers are not contractually obligated to accept payments, this may increase the risk of higher out-of-pocket costs for members, including balance billing. Members might also be very surprised. So they may unintentionally receive care from a provider that they thought was in the network or participating and is not. Or there may be unexpected services such as needing to go to the ER and not being able to check if what those costs may be. It's also uncertain how clear disclosures of these providers will be to enrollees. Further, there may be a lack of provider buy-in. Providers will likely receive less reimbursement for these services. They'll also lose potential revenue steerage or partnerships with issuers by being in a network. And they also may be taking on financial risk due to bad debt. Additionally, some potential operational shifts for issuers. They'll have to figure out how to administer these fixed payment schedules, communicate these payment levels, and address billing disputes. That said, there's potentially some savings due to less administrative burden and not needing to build a comprehensive network. If there is large take-up of these plans, as noted, there will be significant market changes. Premiums will likely be lower, therefore the benchmark will go down. Less APTC, net premiums will go up, and there may be impacts to some of the affordability programs such as 1332 waiver and reinsurance programs. So while this concept is new, we have seen that this market has experienced aggressively priced new market entrants come in and gain market share over time. We've also seen that strategy has resulted in potential insolvency or exiting the market. So really here the question is whether these non-network plans are a solution and if it will be different than that scenario. Can these plans be priced below the current market rates and sustain those lower rates in a financially viable and profitable way? We're thinking this is more of a long-term strategy, potentially not a huge issue in 2027, although it will likely vary geographically depending on state DOI decisions, as well as potentially where there's certain companies that have expressed interest in pursuing not-network plans such as Sidecar or Image 360. On to the next slide. Catastrophic plans were also raised. We talked a little bit about this, but it's opening it up to everyone to be eligible. There's flexibility and increase on the maximum out of pocket, so lower cost of these catastrophic plans, and then also introducing a multi-year look. So this poses a lot of uncertainty for issuers, for actuaries pricing, as well as how other competitors in the market will react. Thinking about how do you price a multi-year plan? How does that fit into ACA rating rules and the URT? Or even thinking about a 1-year impact, if there is, higher take-up of these plans, what would that mean for the single risk pool? How do you think about risk adjustment, given that will be, a lower premium? And how do you consider the morbidity impact that might go into that? There's also potential for litigation on a number of these items. So, if this is a strategy that an issuer is considering, just knowing that you may need to be really on top of different scenarios regarding what is or is not allowed with these plans, given the ACA rating rule questions. So we're thinking for 2027, there's likely a smaller impact with these catastrophic plans and really something to monitor in the longer term. Next slide. So really, we just kind of wanted to tie it all together from the highest level of pricing impacts. So as we started out, there's more than the proposed MBPP that we're talking about here. We have the enhanced subsidies going away in 2026. There's the reconciliation bill, the payment integrity rule, and then in 2026 in general, some of the largest rate changes the market has seen since 2018 and significant carrier and membership churn. So all of those components combined create significant questions and uncertainty in the market. there's key questions around what will the new market morbidity look like? How many enrollees will ultimately drop in 2026 and 2027? How do we think about the member mix and the risk adjustment components? There's a number of scenario testing and assumptions that will go into play. One thing that we're hoping will assist a lot of issuers is early reporting produced by the Wakely risk adjustment team, the WinRAR team, that will come out in the next week or two, giving insights regarding what some of those 2026 membership plan selection, metal mix, and risk adjustment components may be. But going into 2027, there will be a lot of questions and blind spots, even regarding how the 2026 market has moved. So keep in mind, this is not a status quo pricing year. You really should be looking at each of those components in isolation, together, and scenario testing what that might look like. And then also, as data is coming out, as a lot of the regulations are not maybe finalized until even after that initial rate filing, just being very proactive regarding how you may adapt your strategies and your assumptions as new data comes in and things shift. Curran, did you have anything to add?
Yeah, thanks, Michelle. The one thing I wanted to close out by saying, at least on the pricing considerations piece, was a lot of sophisticated carriers with history in the market. Their actuaries will understand a lot of the things that we put in our slides, right? The source of risk is really opportunistic new entrants who might try to leverage some of these benefit flexibilities to put new models out there. It may not be thinking more extensively about all of these issues. So the key will be to continually balancing risks and opportunities whenever there is a change. You don't have to engage on every opportunity. You have to understand the risks, and you have to communicate those risks to leadership. And we, for at least for our clients, we spend a lot of time studying member level profitability, understand where the plan is making money, where they're losing money, and how all of the changes will impact some of these issues. That's been really helpful to us. And with that, I'll pass it back to Zach.
Thank you, Kern, and thanks to all of our panelists. We're going to turn to questions now, but before we do that, I just want to note and highlight that in addition to this webinar, we have published a couple papers on the proposed rule. One focused on a little more focused on the pricing and issuer side impact, and that's a paper led by Wakely, and the other is more on the state and consumer impact of the proposed rule, and that's a combined HMA and Wakely paper. These papers are on our website. They will also be linked here in the slides, which we will distribute after this webinar. Last thing I'll say on that is we did receive a question about whether or not we've submitted comment letters. HMA and Wakely do not do that. We provide assistance to our clients who submit comment letters, and to the extent that you need our assistance now digging into that, we'd be happy to help with that. All right, so I'm going to jump into the questions. We got a number of questions about whether or not the slides and the recording will be made available. They will. We'll publish them. We'll also distribute them to everyone who signed up for this webinar after the webinar concludes. So the first question we wanted to answer live was, for state-based exchanges, how much flexibility would states have to meet the proposed changes? What areas would there be flexibility or no flexibility? I can take that. I would say generally it really depends on the provision, but a couple things I'll highlight is for the verification related requirements, for the data matching and consistency requirements, where marketplaces have to work with the consumer to document their eligibility for coverage or financial assistance. That is very much an operational process that requires tools, technical tools, operational processes, and humans to help navigate and manage. And the way in which one marketplace does it can be different than others. So there's a fair amount of flexibility to comply with that provision in a way that makes the most sense to the marketplace, and state-based marketplaces have used that flexibility to both comply but also make it as simple and streamlined as possible. Another flexibility that exchange marketplaces, state-based marketplaces may avail themselves of is around the new plan types or the availability of non-network plans. All marketplaces have broad plan certification discretion to approve plans for offering through the marketplace that are in the best interest of the consumer. So we could see some marketplaces take the stand that, for example, they're not going to approve any non-network plans because they don't believe that plan is in the best interest of the consumers that they serve. I'm not speaking to any specific marketplace. That's just a flexibility and an authority that a state-based exchange could use. So the next question I wanted to jump to is around federal network adequacy standards in the proposed rule. The question is, are the federal quantitative time and distance standards going away? And this is someone asking us to confirm who is in a state-based marketplace on the federal platform state. Lena, can you take that one?
Yes, we can confirm for SBs and FPs, those are going away. And as mentioned, you have state-based exchanges and FPs have flexibility on their network adequacy standards and their ECC standards that they want to impose in that state level, as long as they're providing sufficient access consistent with the reg.
Thanks, Lena. I'm gonna stay with you. There's another question specific to the federal concern over fraud, waste, and abuse, and that the program integrity risk is concentrated on market conduct by agents and brokers, as indicated by GAO oversight reporting. Does the proposed rule include any provisions addressing this concern, and how might it impact the future role of agents and brokers and their regulators vis-a-vis the exchanges?
Yep. So I think there's notice in this rule that agents and brokers are important for enrollment assistance, but also that there are certain cases where they need to address certain activities of agents and brokers that don't align with the interests of consumers. So the CMS themselves cite expanded regulations on marketing practices. So don't give money to somebody, don't say they're eligible for a $0 plan if they're not, a number of kind of examples that they've given there. They've mandated and updated their consumer consent form for when a consumer is working with an agent broker, so that's a practical implication. And then there's also a number of provisions in the rule that CMS is saying are to avert fraud, and we've talked about some of those as they relate to DMIs and verification under 100 and all those different things. And so for agents and brokers, there are more steps to help consumers with verification than there were before. I think it's notable, though, that there is a pathway for states to do a more agent broker related or broker related model. The only state that kind of does a similar type of model today is Georgia. And so they are providing flexibility for states to pursue that model that is largely agent and broker driven, but there is not mention to specific protections or they're not incorporating these program integrity efforts necessarily in the design of that model. But states that take on that model may need to take on additional responsibilities and monitoring for EDE entities. One of the things they also noted in the rule is this SEIPM program for state-based exchanges. They don't really talk about if there's going to be a process like that for monitoring PTC and whether it's appropriately done for the EDE-like models, but then they're introducing this model. So I think that remains a little bit unseen if there's going to be more requirements or similar requirements. But there's kind of two different approaches. One is here's some more restrictions and more ways you need to help consumers because we're putting more requirements. And then the other hand is we're expanding opportunities for assistance through agents and brokers through that model, such if any state, does take that step.
Thanks, Lena. The next question, or there's a couple questions on the non-network plan, requirement. One is related to how would a non-network plan compare to an indemnity plan? And then the next one is, could non-network plans be accurately described as index plans? And Michael, I'd love for you to take a crack at those, recognizing that those are both pretty complicated questions.
Yeah, I'll start. And as I think things evolved, there's a lot of unknowns. So right, like at the simplest level, at least I'll start with kind of the indemnity portion, right? While we're kind of non-network plans, I've sometimes heard them as reference-based plans, right? They do provide specific amounts of money for a service. Where maybe a key difference is in terms of indemnity plans is indemnity plans aren't classified as major medical insurance. And so that means a lot of the market reform rules do not apply to them, especially in the individual market, right? So indemnity plans can be underwritten. They don't have to follow medical loss ratio rules. They don't have specific like premium rating requirements. Kind of all those things that you would think of that are associated with the individual market do not apply there, right? And so for a non-network plan to be deemed not only like major medical, but also QHP means that they would have to follow kind of MLR rules, right? They can't underwrite, they can't limit enrollment for guaranteed issue. They would have to follow network adequacy requirements that would be for QHPs, and people that enroll, right, could get premium tax credit subsidies. One of the unknowns there is, right, as major medical insurance, right, preventative services requirements apply, right? That wouldn't be in the case of an indemnity plan. And so how does a non-network plan guaranteed, right, 3 free preventative service visits? And some of these questions are, at least from our vantage point, or at least as of this webinar, a little unclear of how would a non-network plan satisfy some of these major medical ACA market reform requirements in terms of cost sharing and things of that nature. And so that's kind of one of the uncertainties. I'm less aware of an index plan. I know of it in the life insurance realm. I'm less certain of it in the healthcare realm, but happy to follow up offline on that one. Anyone else on the panel have anything else to add there?
I think you covered it nicely. And I think I want to jump to one last question. There's a question about changes to filing timelines. I don't think we have any definitive information about that. So we'll move to the last question, which is, and Michelle, can you speak to any impacts that the expanded eligibility for catastrophic coverage may have on enrollment or membership risk mix?
Yeah, I mean, I think it's really uncertain, and usually it just comes down to price, right? So where's catastrophic in relation to a bronze plan? Why might a member decide to buy down to that plan for coverage? They probably expect that they are not going to incur costs up to the maximum out of pocket, and then they can, get that premium savings. From a pricing perspective, right? The question of, is it feasible to have these plans lower than bronze? I think you can see in the market right now, it's kind of a mixed bag depending on how much lower catastrophic is compared to bronze. Because of how small that mix is currently, it's not credible usually. And with the risk adjustment, you can see some really significant payables and receivables that can greatly swing results. And so a lot of carriers kind of steer away from these plans just given that uncertainty. So I'm not so sure that this is going to dramatically change unless there is enough data or ability to really price catastrophic to a meaningfully lower amount. And at this time, it's kind of a a delay. You know, as an actuary, you kind of need the data to signal that that might be happening. So I think we're thinking this is potentially going to sway some people into those plans, but not in a meaningful way.
Thanks, Michelle. And I think that we've hit the hour. So really appreciate everyone's time for tuning in. Like we've said all along, we are eager to help with these issues to the extent that you would like to engage. Please reach out directly. Thank you again.